We're just doing a sound check, right?
Good.
Perfect, thank you. So welcome to the 8th session of the Empowered Senior Speaker Series. It's great to see a full room of people. It's inspiring, encouraging, but at the same time a little kind of concerning that we have so many people who need so much information. But we're happy to be the ones to provide it. I'm glad that you're here, and welcome you back for future sessions as well. Does anybody, I asked earlier, but does anybody need a hearing device? Because we have some here. If you need one, don't be shy. All good? Okay. So just a bit about me. My name is Marian Goard. I'm a real estate broker here in Burlington with Keller Williams Edge Realty. And I specialize in working with older adults and their families on later in life moves or estate sales. And I have a couple of extra designations. One is called a Lifestyle 55 Master, and the second is a Senior Real Estate Specialist, which means that I have some additional training, experience, a network of exceptional specialists that I can call on as needed, and truly, I guess, a passion and a heart for working with older adults. Partly one of the reasons why this series is here, because many of my clients I learned along the way were looking for information and didn't know where to turn, and didn't, in an era of information overload, it's often hard to know what you can rely on, who you can trust, and where you can go. So I just want to convey that this is the place to be, and you can be assured that anybody here presenting to you, providing information, is reliable and trustworthy. Which brings me to the educational partners that we have helping us out. Oh, Jeanette. You're 2 slides behind. Oh, jeez. I didn't know one was me. There I am. Okay, we'll pass that on to the next. Thank you. You did a great job.
Yeah, no,
She's a stand-in today, so yeah. So we have a group of individuals who are supporting this initiative, and they're our educational partners. It's because of them that we're able to bring this event to you at no charge. And I just want to acknowledge, actually, on top of my list is Jeanette. Oh, she's right here. Fluent Senior Transition. So Jeanette looks after transition. So we don't know what that entails. It could be anything. Anything going from here to there, and what do you need, what kind of help, and how can she assist? We have Jared Sia, just kidding, it's Quality Care Burlington. It's a home care company. So anybody who needs kind of to bring in care into your home, you can call on Jared. Beside that, Meredith, I forgot your last name. Jody, she's going with an alias of Rob Hamilton today. Hearing Well Matters, so any kind of hearing assistance, hearing device, you can turn to them. Actually, just mentioned that I dragged my husband down there last week because he is in need of a hearing aid, and as most men, or maybe almost all people, are reluctant to acknowledge that they need some hearing help. He did, and we were very good hands-on with Rob. Beside Meredith is Sarah Sachs from Smith's Funeral Home, so if you haven't made any plans yet, or if you need to look at your plans to make sure that they're still appropriate, then Sarah's the girl to see. Not here today are Denise LeBlanc from Arbor Memorial, same type of situation. They're both into the funeral burial business. And Kim Rutledge is a new partner with us. She is with Vistamere Retirement Residences in Oakville. She will be on site with us next month. Paul Cuttajar is with a company called Senior Care Access. They also have a transition business, but also probably the most extensive online resource for looking for retirement type housing. I didn't miss anybody else. Sorry, Irene's Yoga is 360 downsizing. So when you're in that position where you're perhaps making a move and you don't know what to do with your stuff, you're going from here to there, and you need some help with that, Irene is your girl. Can't say enough about these folks, and if you haven't had a chance to visit with them, please do. As I mentioned earlier, they are all trustworthy. Oh, sorry, and I forgot Neela. I'm sorry, Neela's here on the side. Neela White is with Raymond James, also to back up a bit. She's also one of our educational partners, looking after anyone's financial affairs. Again, these are all great people, all trustworthy, reliable, and you wouldn't be making any kind of mistake in speaking with them. Also like to acknowledge Ida, she was at the door, and Lisa, who are my kind of right-hand women, help me out every month in getting this organized and facilitated and make sure everybody is by seat. And then today, actually, a special thanks to Jack and Bruce, because they're the ones that brought us those Lindor chocolates. I wish I could take credit for it, but it was them. So thank you so much. That was very kind of you. Happy Valentine's Day, right? Okay, next one. So, before we get started, I've just got some little bit of housekeeping and some announcements. So the first is please turn off your phones, just put them on silent. We've got a lot to get through this afternoon, and the plan is to wrap up by 3 o'clock. You've got some notepads. Please use them. Jot down any questions you have. Today's presentation is going to be a little bit different. We'll have 3 presenters. Each will speak briefly. Then it's an Ask the Expert session, so you'll have an opportunity to ask, but I will get us started with some questions. But in the meantime, if you have something that you'd like to make sure you don't forget about, then please do just not jot that down. The pens that you have, so if you have trouble with them writing, it's because they've got a little wee red tip on the nib of the pen. So you just have to flick that off. It's probably a little bit hard to see for some, but that's the reason they do work. Included in your handouts today is the information about our educational partners. So again, please do use that as a resource for yourselves. And on the back of that page is an important announcement. Next one, please. Thank you. So you can see our room is full. It's getting fuller by the month. And so we've had to make the decision about where this goes. So next month and the months beyond, all the sessions will be at the Burlington Art Gallery on Lake Shore. There's lots of room there. We'll be able to bring back tables and chairs, so better, more convenient seating, comfortable seating. The dates remain the same as have been published until now, with the exception of May. May was originally listed as May the 15th, but now it's going back to May the 8th. Generally, the sessions are the second Wednesday of every month. So this year, the April session is not that, it's April the 3rd, and the May session is going to be the second Wednesday, May the 8th, which is different from what was communicated initially. The other thing to note is there is lots of parking, but unlike here, it's not free. So what we're able to do is the art gallery is calling the city off so that no one will come and tag a car there. So when you're coming in, you don't need to pay for parking at the machines outside, but when you come in, you'll be asked to pay $3 for the afternoon. So that will cover you. I don't know whether they'll give you a ticket or not, but you don't need to go back to your car to put a parking tag on your vehicle. Yes, ma'am.
$3, is that going to be cash or are you going to have a machine for debit?
I would expect they're gonna ask for cash, but I really don't know, and it's out of my hands, but I can find out. I would plan on cash. I would plan on cash if you can bring the $3. And it's good for the afternoon, so you won't have to leave. You can stay and enjoy the art gallery once you're done, or come a little bit earlier. Okay, so part of that is, it's really, 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 really important that I have your current contact information. So I've been sending out emails, and from my end, I can kind of see who's getting them and who's not. But if you are not receiving an email from me, and you think that I have your email address, please do let girls know. Okay, because otherwise I don't want someone here and saying, where are you guys? And we're way on the other end of the city. Okay, so please, it's more important than ever, and a phone number and where I can reach you. And I will make sure that I contact everybody between now and next month to make sure that everybody knows where we're going to be. Okay, but please do make sure that I have an email address. And also sometimes even if I have an email address from you, it's getting spammed out. And sometimes you get them, sometimes you don't. So really important that we take care of that. Okay, so now, on to today's session. So, based on our room full of people, estates, finances, and taxes is of interest to many. And today, we have three incredibly capable professionals, and they'll help us understand the ins and outs of many aspects and underscore how all these concepts intertwine. And as I mentioned earlier, the session today is a little bit different. Each of our panelists, will start off with a short presentation, then we'll have some Q&As, then we'll turn over the floor to you. Okay? So first up will be Gosha Sekhon. Gosha is the principal lawyer and owner of Sekhon Legal Services in Oakville. She's an 03 graduate of Queen's Law School and was called to the bar in 2004. She's a member of the Society of Trust and Estate Practitioners in Canada since 2016, when she obtained her Trust and Estate Practitioner designation. She's been in the trust and estate industry for over 18 years and has extensive experience with complex planning considerations involving incapable beneficiaries, small business. Is that right? Incapable beneficiaries? Okay, you'll have to just tell us what that means. Small business interests and blended families. After Gosha, we'll have Neela White. Neela, as mentioned earlier, is one of our educational partners, and she's the partner and co-founder of Blue Wing Advisory Group, Raymond James Limited. She has more than 25 years working in the financial industry, providing insight and inclusive wealth management services for a variety of clients as both an aging specialist and senior portfolio manager. And she advocates for the open discussion and preparation for life-changing illnesses and their burdens, both financially and emotionally, to better equip and protect families against any long-term costs. Her relatable style inspires families to examine their financial plan and empowers them towards a fresh conversation about viable options. And lastly, who have had my back to the whole time, is Steve Jones. He's a chartered professional accountant and partner at Jones Thomblison. Steve specializes in working with owner-managed businesses, professionals, and individuals. And over the years, Steve has worked with hundreds, if not thousands, of seniors and estate trustees. So, let's get started, and welcome, Gosha.
I'm guessing I should stay. It'll probably be easier if I stand for this. Yeah. Okay.
Could you speak up?
Yes, I know. I was just about to ask if you can hear me because I'm very soft-spoken. So we'll get started with my slides, and I'll just do a brief introduction of myself and also explain a little bit about what the incapable beneficiary is. So because I'm a lawyer, I have to put this disclaimer in. So it's just standard that this isn't meant as specific legal advice, and if anybody has a particular question about their circumstances, they need to make sure that they do get the appropriate advice for their situation. So go to the next. So very quickly going to introduce myself in a bit more detail in terms of my experience level. I would really like to hit on the top 5 myths around estates, estate planning, and wills. And then I would like to leave you with what I consider a bit of a checklist or a to-do list for making sure that you do have a plan in place and the best way to approach your planning. So, go to the next slide, yeah. So again, Marian has already mentioned I have a lot of experience. Okay, I don't have as much experience as anybody in this room, frankly, but I have a lot of experience, specifically in trusts and estates. And I have it in a mix of having worked in private practice with legal and other law firms, but I also have experience working with executors and trust companies that have acted as executors. So really what that means is I have a dimension to my perspective where I've seen how things go wrong. When you don't have the right sort of planning in place, when wills haven't been drafted properly, or if somebody doesn't have one. And that experience is what has really led me to do a lot of these speaking engagements and public service announcements, if you will, on why it is important to make sure that you have your planning in place. And as Marian also mentioned, my clients are varied. I work with small business owners, I work with young families, I work with retirees. Thanks to COVID, I now work with a lot of people who are separated or divorced. And in terms of incapable beneficiaries, what I'm referring to there is But I work with a number of families where they will have a special needs child or somebody with a disability in the family that they need to make appropriate planning for. And that requires a very specialized approach, because what you don't want to do is affect that individual's ability to receive government supports down the road. And so structuring a gift to a family member that has a disability or special needs and is reliant on government supports is a very detailed process and one that I'm very well versed in. So I'm going to go now to the next slide. So just out of curiosity, how many people in the room have a will? How many people have a will that they have done in the last 5 years? It's actually better than I thought it would be. So I'm just going to go through what I consider to be the top 5 estate myths that constantly come up in my conversations with people, both at these educational seminars and through my work with clients. The first is this perception that if you don't have a will, that your assets are simply going to go to the government. I don't know where this started or this expectation or this perception started, but what I can tell you is that in Ontario, if you have somebody that has passed away that did not have a will or a valid will, we have legislation that dictates how their assets are going to be distributed. And there is a sort of family hierarchy that is applied to the way that things will be distributed. So for instance, if that person is married and has children, there is going to be a division between the spouse and the children, but there is a formula that's applied. So it's not that everything goes to the spouse and that they would look after things for the kids. And this can create problems where you have children that are minors, because if you're under 18, you can't receive your share of the estate outright. Another level to that legislation says that if this individual that has passed away without a will didn't have a spouse or children, we then look to whether their parents are still alive. And if not, then we start to look at the sibling level. Now, what you can appreciate in terms of complexity of family dynamics is that not all siblings like each other, and not all of them are living with this, default expectation or like joy with their heart that suddenly everything that they own is going to go to their brother that never did a hard day of work in his life, or whatever the case might be, right? So the important thing with this is that even though there's a plan through the legislation for how things could be distributed, it might not be the way you wanted things to go. So it's less about the fact that all of this would end up with the government and more about where is everything going to end up, and would you really have wanted that to be how things played out. So the next one, where I asked everyone how many people have a will, so I don't need to worry about it. Well, in my recommendation to clients, even if you have done a will, at least every 5 years, you should be reviewing that document to see if the terms still work with your current life circumstances. And obviously, if something happens, a major event in life, you want to revisit it much sooner than that. But at a minimum, I would say there are the stages of life where you are now an adult, whether you're married or not, and you have assets, and you want to make arrangements for those. Then, and this is happening less and less often, you get married and have children. Like, frankly, I don't know how often that actually happens anymore, but I think some people are still doing that, where they get married and have children. And you want to make sure that your new family is well looked after and that your assets are taken care of. And then as time goes on and your children grow up, you realize what their personalities are like and how capable or not they are of managing financial affairs, whether they will need assistance in doing that, what their own relationships with their spouses are like, whether that requires protecting their inheritance in a specific way. You're going to revisit the documents. And so What you don't want to do is say, okay, I did the will when we got married and had kids, everything's settled, and I'm just never looking at it again. Because it may be that the way that the will is set up just totally doesn't work well for really properly looking after your loved ones based on the changes in your circumstances. So that's another reason, that's a big reason to do your reviews on a regular basis. So this third one is really popular these days. Adding an adult child to your property, whether it's a bank account or your house, because you're trying to save probate fees. So this is one of the most heavily litigated areas of practice in trusts and estates right now, where, you know, the parent has gotten older, perhaps they are now widowed, and they think, okay, well, I've got the 2 kids, I want them to benefit anyway from whatever I have. I'm just gonna add, you know, Lucy to my checking account, Bob to my savings account. There's about the same amount of money in those. They can each have them when I'm gone. And I'm gonna add them both to my house with right of survivorship, so that when I pass away, they're both gonna become the owners of it. Well, I'm gonna let Stephen speak to the tax implications of some of these choices, but from a distribution perspective, it is quite problematic. And also, one big thing that everyone forgets when they decide to go down that road is it's no longer just your asset. You have lost control of that, and now somebody else has a say in how you're gonna deal with that money or how you're gonna deal with that house. If you decide that you wanna get a HELOC, the co-owners now have to be on board with that plan. If you decide that you wanna downsize and sell, your co-owners now have to be part of that agreement of purchase and sale, and they may or may not agree. And the other, with real property specifically, again, I'm gonna let Steve speak to the tax implications of it, but if it's your principal residence and you added somebody else on as an owner who themselves owns a house of their own, there's a lot of income tax triggers that happen there. You lose part of your principal residence deduction. They end up having not just their own principal residence, but now they have this property that could be result in capital gains taxes for them. It can become quite a bit of a mess. And again, as I said, my biggest concern with these sorts of steps being taken is the loss of control before it has to happen. The way to best deal with needing assistance with managing your assets is to make sure that you get a power of attorney put in place instead. And that'll give somebody the authority to help you without actually becoming the owner of your property. So the fourth myth that I've seen, less and less, I guess, is families are getting more complicated. But it's the one where people say, oh, well, my kids know what I want. They get along, everything will be fine. I don't really need to spell out that I gave that $200,000 loan to Tom for his down payment. Everybody in the family knows about that. Let's keep it simple. The kids will know what to do. And then my colleagues who are estate litigators, who make a heck of a lot more money than I do, are very happy to see that happening and being able to, sort through that. So I would say, don't have those sorts of expectations, because first of all, grief does strange things to people. Second of all, sadly, greed definitely does strange things to people. And 3, there's a lot of things that happen, and you have siblings. There's a lot of things that happen between siblings that parents sometimes aren't even aware of. There are dynamics in sibling relationships that they almost like hide from their parents in terms of how well they get along or not. And they'll put up a brave face during family get-togethers, but there may be more going on between them directly than they want to like stress their parents out about. So the reality is, if you want things to play out a certain way, if you want that loan you gave Tom to be counted towards his share, it's important that it be written in the will. And yeah, that means it's going to be a more complicated document, but it's also going to mean less problems down the road. Okay, so the last myth is sort of the opposite of the first one, where there's this expectation, well, I'm married, so everything is going to go to my spouse. And as I mentioned with the first myth, the legislation doesn't actually say that. I mean, if you happen to be married and you don't have kids, and maybe then it'll work out that way, but it's not guaranteed. Second of all, your spouse is still going to have to deal with stress of getting appointed as executor of your will, which may have been avoided. Of your estate, executor of your estate, which may have been avoided if you had a will, which is a whole other process that we can go through. But this expectation that, once you pass, everything just simply goes to your spouse, that's really dependent on how you own things, how you've done your beneficiary designations, and again, if you don't have a will, the legislation will take it down a different road altogether. So those are some of the more common things that I've come across. My recommendation to avoid falling into these traps, if you just want to go to the next one. My recommendation for avoiding the traps and pitfalls of those myths and those misperceptions is to have an appropriate plan in place. And I wanted to just give you some steps that you should go through for making sure that your plan is viable and it's done well. One of the things that I've conveyed in numerous of these engagements, if you hire somebody to help you plan your things, to prepare a will, put your powers of attorney in place, and they don't ask you a single question about your assets or your family dynamics or anything, like if they're literally like, okay, what are your instructions? Here's your document. My advice to you is to run because they're gonna have missed something. There are ways that people own their assets. There are implications of your family dynamics that you really have to discuss completely and properly to make sure that the plan you're putting in place works for your loved ones. So as a first step, you would want to have an inventory of everything that you own and anything that you owe. So any debts, mortgages, anything that might come up as like a personal loan. Make a family tree. I recently had a client that hired me to do a probate application. Her sister had passed away without a will. So we got started on the application. I asked her several times who's in the family, because there's no will, this is how things can play out under the legislation. A bit of due diligence, a bit of sort of soft, more general conversations just to make her more comfortable. More and more information starts coming out. Oh no, I'm the only sibling. Oh well, there is that sister that we haven't seen in 60 years, and I don't actually know if she's still alive or not. And that really kind of threw a wrench in that application, the way that we started it, right? Because then there's other steps that you need to take. To avoid a situation like that at the outset, you want to be very clear about who is or is not in the family. And even if somebody is estranged, at least make a note of that so that there aren't any surprises down the road. Because they may have to be notified in any case. Then obviously you want to hire a professional. So that would be the three of us. Advisor, not us specifically, anybody who's tax advisor, real estate, estates, and financial advice. And so, because you want to make sure that if you're talking to your lawyer and you're like, okay, this is what I own, and this is how I want to leave this asset, that you then also talk to Stephen and say, okay, what are going to be the taxes that I'm going to have to pay, or my estate is going to have to pay in leaving it this way? You need to know that. And in the background, as you're living your life, you've got Neela taking care of that asset. making sure that it's building up, and also that she's able to step in and help the person that receives it on the other end. The biggest conversation you're going to have with your lawyer is around what your goals are. Is it your goal that everyone be looked after equally? Is it your goal that even though you would like to look after everyone equally, you know that that one person is going to take their cash and blow it on a spending spree for whatever thing, or that their marriage is in trouble, and that if they get that money, there's a risk of it all being divided in a divorce. How are we going to approach the right way to set up those gifts? And part of the conversation you also need to have with the lawyers about how you own things. So there's different ways that things move to the next person on somebody's death. Whether you own things jointly, whether you designated somebody as a beneficiary, whether something is just in your name alone. These are all things that we have to map out as part of the plan. So it's not just about the instructions in the will. And as I mentioned with the beneficiary designations, you need to review them. You need to make sure that they are up to date, that if you transferred, or if you can speak to the admin process on this side, but what I've seen is sometimes people will have an RSP that has to be rolled over into a RIF, and the beneficiary designation gets lost somewhere along the way. And you have to make sure that those are actually updated if the account's been converted. Or if you're setting up a TFSA, there are a couple of different ways that you can do designations on those, which I think Neela's can speak to. Yeah. So those all have to be looked at in detail because they're outside of how the will is going to work, but it's going to be equally important for how the global estate and your assets are going to be transferred. And then, of course, you want to get a good handle on the taxes that are going to be owing, either on probate. So just so you know, there's a big difference here. Probate fees are provincial level tax. They're actually called an estate administration tax. Only the provincial government takes that. They have a formula they use for applying it to your estate. It's about 1.5% of the value of your estate. Now compare that to income taxes, 30, 40% of whatever income you're making. But income taxes are also something that really needs to be paid attention to. Because, for instance, people don't understand that when you pass away, for income tax purposes, it's as if you sold what you owned. So let's say you had money in a registered account, $200,000. When you pass away, unless that $200,000 is going to be taken by a spouse and put into their own registered account, it's going to be exposed to potential income taxes. It's going to be as if it was totally withdrawn, which sort of ties to my bottom point about life insurance, which can come in handy for covering those sorts of expenses if they're going to be significant at the date of death, in a way that your year-over-year taxes might not be. Obviously, put a will in place. Let's make sure the actual document is there. We've looked at how you own things, we've looked at how things are going to play out and what your goals are, but let's now document how you want things to be distributed, who's supposed to be in charge, how everything is going to be administered. And I add buying life insurance in there. It's not something that people realize the benefit of as much as I wish they did. I mean, I guess that's the long and short of it. It's life insurance when it comes into your estate is it's not subject to income tax. The whole amount is available to deal with other expenses and taxes, probate fees, admin costs, and then if there's anything left over, it can go to the beneficiaries. So I think it's an underutilized tool as part of your estate planning, something that you can definitely consider once you've gone through this part. of things. Because I'll give you an example. If you have an estate where your biggest asset is real estate, and you have a RIF where you have to pay, a big chunk of income taxes, it may take time to sell the real estate and come up with the money for taxes. But if you have a life insurance policy that's paid out on death, the money is available more quickly to deal with that. And also, then it also doesn't take away from the value of the real estate. So that's a very, very simple example, but I just wanted to highlight why I think it's something that we need to turn our minds more to when we're doing our planning. And that's me.
I guess it's me next. So I think in continuing with the theme of what we're seeing a lot of right now, tying in with Gosha's, before we start with RSP, the one thing that we're seeing a lot of now with our older clients is that the older clients are jointing their accounts with their adult children. And again, it's the idea that when I die, the asset's going to be kept intact for my son or my daughter by putting in joint name. So from a brokerage, from an investment house perspective, what you have to realize is if you joint your asset with your child, your investment account, so an unregistered and non-registered account, that child, adult child, has the right to make investment decisions on that account because they are equal owner. So they can make investment decisions that you may not agree with as long as it's within the risk and objectives of the account. They can also remove money from that account without the obligation of notifying you. So that's one thing that I just want to point out because we're seeing that a lot, that older adults are doing it as a form of safekeeping their asset. The other thing that we're seeing now as well, and this may be a byproduct of COVID and stuff, is if you do joint that asset with your adult child, if the marriage starts to break down, when you have to provide a list of assets, that is one of the assets that they have to include on their asset list. So be very careful with stuff like that because most people do not have that intention that their asset is going to be divided by my son or daughter's marriage breakdown or to be used by my son or daughter. It's just as a probate mechanism, and it's just to try to protect the asset. So that's one of the things I just really want to highlight that we're seeing more and more of right now. And as Gosha said, it's having to, and it is an uncomfortable discussion, having to bring it up in front of everyone so everybody has the same understanding, even if it's not the intention, because life happens. So that's a big one. And the other one we're seeing that we always highlight is blended families. So sometimes what ends up happening is for a registered plan, an RSP, a LIRA, a RIF or a LIF or a TFSA, there's a marriage breakdown, somebody gets remarried, and they begin changing the beneficiaries of their plan, making it their new spouse. Without the understanding that when they die, their RSP or their RIF will roll to the new spouse, so now it's their asset. When that spouse dies, that whole asset, their piece plus a deceased person's piece, will roll to whoever they have put down as their beneficiary. So remember that if it's the idea, well, my new spouse promised that on death, it's going to be split equally between your children, whatever's left between your children and my children, unless it actually says that on the new RSP, it doesn't matter. Okay, so we need to be careful with stuff like that, with changing beneficiaries without understanding the intention of somebody's promise to follow through on your wish, I guess. So I'm just going to briefly touch on some registered plan stuff, just because it's stuff that we're seeing and we're being asked quite a bit lately. So for RSPs, the calculation this year is the maximum is $31,560 that you can deposit to your RSP, or 18% of your earned income to a max of $31,560. Any contribution in an RSP that's made within the first 60 days of the calendar year can be used on 2023's return or current year 2024's return. RSP contributions are tax deductible. The withdrawals are taxed as income. So if you do a deregistration of assets, of money from your RSP, it's taxed, and then you get a T4 RSP slip. At age 71, it's mandatory that a RSP is converted to a RIF, and withdrawals happen at age 72. If you withdraw more than your minimum, you'll be taxed. So if you draw $1 or $5,000 more than your minimum, there's extra tax that's applied. In an RSP, something that's commonly that we're asked is, well, what can I invest in? You can invest in almost anything. So it's not just mutual funds, it's not just stocks, it's not just bonds. It's fairly open, except for pink sheet counter over the pink sheet stocks, which are very small, non-regulated sort of stuff, and private corporations. Next slide. So, when you are at the age when your RSP is converted to a RIF, and you can convert it ahead of age 71 if you want to, it is funded from an RSP. It's not a collapse of the RSP. Basically, you open just a brand new account, the assets roll as is, in kind, into the new account, into the RIF. At the end of the year you turn 71, CRA mandates that you take, that you convert the account, and the way the calculation is made is on December 31st, the assets are valued, and pretend that value is $100,000. The following year's payment is based on that value. It's a percent, it's a calculation, and it's fixed. And you can take more than that, but if you take more than the minimum, it's taxable at source. There's no minimum withdrawal in the year the plan is opened, but if funds are withdrawn, they are fully taxed. Once the minimum is established, any amount above and beyond the minimum can be taken. The beneficiary of a RIF can be anyone. So it does not have to be your spouse, it can be anyone. However, the advantage is if it is a spouse or a partner, there's what's called a spousal rollover, and it's tax-free. You get a T4 RIF. It goes into their plan and just continues on. The payments can be based on their birth date or on the deceased spouse's birth date. And again, with a RIF, you can invest in almost anything. Nothing's precluded for the most part. Next one is a LIF. So a LIF is funded from a LIRA, which is a pension, and it follows almost the exact same rules as a RIF. The only difference is you can actually convert all or part of your LIRA into a LIF at age 55 or older. So you can if you need the extra income as a bridge. There is no minimum withdrawal in the year that the plan is open in the LIF. But if funds are withdrawn, it is taxed. And the difference between a LIF, a life income fund, and a RIF is that there is a minimum and there is a maximum. Because it falls under different legislation, you cannot take more than the maximum in a LIF unless there's certain things that happen, diagnosed with short lifespan, income issues. So there's about 5 different things that you can do. The difference as well with a LIF compared to a RIF is if you are married, your spouse is the default beneficiary. For that spouse not to be the beneficiary, they would have to sign what's called a spousal waiver form to give up their right to that plan upon your death. Next slide. Okay, TFSAs. This is probably the area that we find we get questioned a lot about with a lot of bad assumptions. So let's start. TFSA, the minimum contribution this year, or the maximum contribution, beg your pardon, is $7,000. The contributions are not tax deductible. These are after-tax dollars that you're putting in the tax-free savings account. To open one, you have to be 18 years or older, a Canadian resident, and have a SIN number. If you have never opened one, the maximum cumulative amount that you could contribute to year-end would be $95,000. The withdrawals are not taxable. If you do withdraw money and you are collecting OAS, because it's not considered part of income, it does not affect your OAS payment. There's not a clawback as a result of removing money from your TFSA. If you withdraw funds from a previous year, it is added to the current year's contribution. So if you removed $10,000 from your TFSA in 2023, in 2024, your contribution is $7,000, which is what the maximum you can contribute this year is, plus the $10,000 you removed last year. So the room stays in place. Any unused contributions from previous years, it's added to current year's contribution room. There are no withdrawal restrictions. So if you were going to withdraw your whole account, you can, and it does not affect what you're taxed as for your income tax rate. There's no limit on the carry forward, and again, you can invest in just about anything. So why I keep pointing out invest in almost anything, a lot of times we'll hear from clients who deal with banks where they say, no, you're only allowed to invest in money market or high interest savings. Okay? That is not true. You can invest in just about anything again in the TFSA. Next slide. Oh, and just like Gosha, I have to put in my disclaimer, so that's my disclaimer. Short and simple.
No one will ever read it.
So, right, so what happens with the tax-free savings account? It does change. So when tax-free savings account first started, the contribution was $5,000. We're up to $7,000 now. So next year it might stay the same, or based on inflation, it might increase.
Every year.
Yes, they do. Yeah.
So I don't have a disclaimer. That was a beautiful one that just had. Mine is, if you have a problem with what I say today, just remember, the advice you receive is worth exactly what you paid for it. So don't sue. That's my disclaimer. Usually when I do a presentation, I want to spend just a tiny bit of time on our income tax rates, because sometimes it's misunderstood. Now, I've done this on I said approximate at the top, because there's a whole bunch of different rates. Province kicks in at a certain level, and the feds kick in at another level, so I've just done this kind of simply. And I said here that usually the first $15,000 of income does not get taxed. Now, if you're a senior and you have low enough income, and if you have a lot of medical expenses, you could probably make $20,000 or $25,000 and not pay any tax on that income. But as you go up, then, I'm saying from 15 to 50,000, this is a 20% tax rate. So it's not exactly 20%. I'm just giving you a rough idea. So you should know where your income level is at, and then you know, oh, this is the tax rate that I'm at. So if your income goes up above, say, 50,000 up to 87,000, your tax rate is 30% roughly. And so you know that as you go up in Canada, we have a progressive rate tax system. So there's a big misconception that if I go into this rate right here, this level, I'm going to pay 30% tax on everything. Well, that's not true. You pay 20% on income at this level and 30% at this level. And as you go up, you can just see, your income level, say 107 up to 150,000. It's a 43% tax bracket. There's a bunch of other levels in here, about 3 or 4 levels in between here that are like 33, 35, 37%. And then you go higher from 165 to 220,000, you're at 48%. Above that, you're 53.5%. So most of you probably don't have to worry about paying the 53.5%, but we were just talking about if you have a RIF, and you have 200,000 or 300,000 in there, and when you die, that it throws you into that higher tax bracket. So your heirs, your estate, may be paying tax at 53.5% on death. So I put these rates in here because there can be some planning things that you might do. I had one fellow he was a financial advisor, and he had his mother was in a home or whatever, and she had lots of income, and maybe she was at about $140,000 of income. But she got a diagnosis that near the end of 1 year that she may die in another year or two. So he said, why don't I take out some money, she had money in a RIF, and he was happy to pay 48%, because down the road he might pay at 53%. It's just an astute heir or beneficiary who says, I'd rather pay a little bit of tax now, because mom's not gonna last too much longer. So there can be a little bit of planning around that type of thing. So we'll go to the next one. So I put in medical expenses is a huge thing for seniors usually. And I put the word in there, I said including dental, because I get surprised every once in a while. I'll say to somebody, do you have any medical expenses? They go, no. And then I say, do you ever go to the dentist? Oh yeah, I spent $5,000 there this year. Well, that's part of your medical expenses. So there's a long, long list of expenses that could be included. You can find that on a CRA website. And I put in here that there's maybe start with this one first, net out of pocket. So if you had an insurance plan and you're submitting your bills, it's the out-of-pocket cost. So if you have 80% coverage of your dental, it's the 20% that's not covered that you could claim in this medical area. So normal type of medical may not be enough, because I say there's a threshold. It has to be over 3% of your net income. For someone that makes, I think, about $80,000 or so, there's a threshold of $2,600. So if you don't have enough, if you have medical expenses not over the $2,600, then don't worry about it. I should say you should probably keep those receipts, because maybe in a following year you may have a lot more medical, and you can claim medical like any 12-month period that ends in the year. A lot of people don't know that. So if you had a big dental bill at the end of 1 year, and you're going to continue with the dentist in the next year, together those 2 years may put you over that threshold, so you want to keep those receipts. So, no, it's a 365-day period. It's like a moving. Most people claim it in a calendar year, but say you don't have enough 1 year. I'm just saying, don't throw those expenses out. You may be able to claim them in the next year. So if something could come up and you got a big cost the next year, then you could say, oh, I'd bring some of that in from 2023 and put it on my 2024 tax return. And I'm putting in a lot of things that people often don't know about or don't see, but if you're paying premiums for health insurance or out-of-country travel insurance, that's eligible as a medical expense. And occasionally, I mean, if you're out of the country, you're in Florida for a while, and you've got to get medical treatment. Sometimes I've seen bills like $100,000, you know, and there's helicopter flights or whatever it is to fly them back to Canada to get their treatment or whatever. Those types of things can be included in the claim for the medical expenses. So you may get coverage for it, but stuff that you don't get covered for, it can be big bills, and you want to be able to claim those. So they'll get challenged and questioned, but that's part of the game. And the other one, big one, is a disability tax credit. Maybe a lot of you have heard about it, but I'm still surprised because I get lots of new clients, a lot of seniors every year, and I ask them the questions. Okay, let me see last year's tax returns, and then I'm looking for, I don't cherish this, but I do like to look at a tax return and find a mistake, and then get your money back. Sometimes it can go the other way. I turn a blind eye to those. But this disability tax credit certificate, it's probably, if you can get it, it's been worth recently about $1,700. This year I looked at the calculation, it's about $1,900 like in your pocket if you can get this certificate signed by a doctor. So it says that you've got a severe or prolonged impairment and that there's a lot of judgment that goes into it. And there's a long form that the doctor has to fill out, so it could be, your eyesight. And if you're over 90% blind, you're eligible for it. Or your hearing has to be pretty severe. And can you hear me today, Fran, by the way? Sorry, I put her on the spot. She has her husband in the back and he can't see, but can you see? Can you see that I'm here, Fran? Are you awake?
Keep going, Steve.
Okay. So, what was I going to say? So, yeah, so this form is very important. I would usually say to you, if you think maybe you're eligible for it, or it's a spouse, or it's a parent, or somebody, you want to call the doctor and say, would you be willing to sign this form? And they say yes, then you want to fill in that form, get it sent into the government. They can check off a box that says, go back and check off, fix up my prior year returns. So I've got a lady that just came in, new client, and she didn't know about the form. So we're gonna send it to the doctor, and I said, well, how long have you had this condition? She said, 23 years. Okay. So in earlier years, 10 years ago, maybe it was worth $1,500. So I would say if you got 10 years of $1,500, it's $15,000 in your pocket or more. So it's worthwhile looking into it. So, if you've got friends, so there's all these issues. I say eyesight, hearing, whatever. Could be walking, mobility is a big one. Sometimes if you've got a number of problems or challenges, it may be enough. One of those on their own may not be enough, but if you have 2 or 3, it can push it over and get you this credit. Yes?
A lot of this, the hearing aids.
Yes.
How bad does the hearing have to be under it?
For that, it's pretty well like 100%. It's 90%. It's got to be very, very severe. Like you're deaf, so.
I'm just gonna let you know that there, a lot of doctors will push back in filling out these DTC forms. If you got that problem, there is a company out there called Benefits and the number 2, and they are working with a medical doctor to move these things along. So just see me if you end up having a hard time getting that DTC credit done. Talk to me. I know people, and we can get that moved through. So I can give you that information.
Okay, good. There's other little things in there. Could be if you're taking care of someone who is disabled, then you could possibly get caregiver credit. These ones are somewhat difficult to get. They challenge it and question it often. And then there's new changes where now the doctor could actually send in the form. And
I just want to say, I did go to my doctor, she did fill out the application, and then she said to me, they might not accept it on first go, come back. Have you seen that happen?
yeah, so she's asking the question, the doctor cautions and says, oh, they might not accept it. So, and occasionally Canada, I've only had usually the doctor fills it out, it's a slam dunk, it's good. Not always, but so I had one guy with tinnitus, whatever you pronounce it, and it was severe. He had to quit working at 57 years old, and the doctor filled out the form, and he did a lousy job of filling out the form, sent it in, got rejected. And then he said, you got to do a better job. So we did it again, sent it in, it got rejected. He did it one more time, and he got it accepted finally, but it was after about 3 years of being persistent with it, because that's a severe problem. Like, if you got ringing in your ears and you can't function, he had to quit his job and everything. Like, to me, I don't know why it ever got rejected in the first place.
I'll just make a comment that we did have a presentation last fall on the disability tax credit. So if you go on the empoweredseniors.ca on the website and look at past events, you'll be able to look at the video replay from that session. So it was the entire session was focused on the disability tax credit, and I think you'll find that very valuable.
We had a question here.
If you get the designation of a disability credit, does it carry over to the next year? Or do you
Yes,
have to renew?
usually it would say it's permanent. It's a permanent, prolonged, severe or prolonged impairment. Usually it's permanent. I've seen ones where there's like a child who's maybe got the autistic, they're on some spectrum, and the doctor says, we'll reevaluate in 5 years. It could be, so then it goes to CRA and then they approve it, and on their system it says you're allowed from this year to that year, and then it stops. You have to reapply after. So once you do it and it's permanent, it says, it shows on the CRA's website, from 2012 to indefinite. It goes forever. So, is there a question up here? No? Yep. Okay. I mentioned tax-free savings account. Oh yeah, get your limit. If you go get your limit from CRA, it might not be correct. It might not, because there's a timing of it. There's a timing of when it gets. If you're looking at it to say, how much can I put in like today? It'll have this year's limit. It'll probably have last year's limit, but it won't necessarily have what you contributed last year. So if you forget about that can cause you a problem. And if you're over contributed, like, it's a nightmare. Ken, it's a nightmare, right?
Right.
Right. Okay. This one's I don't know why this drives me nuts. Some things that governments do, they're putting in these new trust reporting rules that you're gonna have to do it this year before the end of March. They talk about bare trust. So if your child is on the title of your home, you're supposed to report that. Nobody knows that, it's just started coming out. You're gonna hear it over the next month or two, because you have to file like a trust return by March 31st. And it could be the parent is on the title of the child's home, that's a problem. Could be holding a bank account in trust for a child or a grandchild. You have to report that on a separate trust return. I think it's absolutely ridiculous. Child or grandchild, it's like no matter what. It is usually.
If that adult child is and only is triggered upon my death. She has no control over the house.
Yeah, I know, it's ridiculous, but you gotta report it to the Canada Revenue Agency.
As this year?
Yes.
Because it's not previously.
No, just this year. And the filings have to be done by March 31st. So there's gonna be a ton of them that won't ever be done. Tell me. What's that?
Crack down on, international money laundering
Oh,
or
yeah.
something, I don't know, or people with large incomes hiding, I don't know.
The
That's
people
what I-
that are hiding aren't gonna report it. It's just ridiculous. Comment in the back.
Excuse me, I'm sorry, my sinus is.
Can't hear you, sorry.
Child on title of parent's home. Is that the same as if the child is on the title with the parent's account?
Yeah, all of those things. Yeah, I've only put like 3 examples.
No, but what-
There's a long list of things that catch you.
Okay, so like if you had your children, or one of your children, or all of them, on your bank account and your investments and everything, that all gold has to be reported?
Yes,
You're gonna scam companies.
crazy,
haven't
it's
we?
crazy. But anyway, I'm sure we'll go through this is the first year, and there'll be lots of things that'll come up, and they'll probably back off on things. You probably heard about the housing tax credit, that was a ridiculous thing.
That's true, and horrible thing.
Yes.
My understanding is that the child also has to file a return if they're in trust. It's effective
And I
December.
think it's just the,
No, December
no,
30th.
both?
December 31st,
Okay.
the legislation is that the child always has to report and hold it. You have to have a trust certificate. They have to report it every
yeah.
year.
But if you do the trust, and it says, oh, here's the settler, and here's,
If you set it up specifically as a fair trust, they
Yeah.
changed the law at the end of December. Effective December 31st.
I'm just gonna comment, you have to provide, the beneficiary's name, you have to provide their birth date, their SIN number, and their address, both beneficiaries and trustees, and it's a yearly filing. So it doesn't matter if the trust agreement has been set up and it's not changing, it's a yearly, schedule that you have to send to CRA by end of March.
No, we can't hear.
sorry.
Can you repeat the question?
That's different. Yeah, sorry. So we're saying, so if you've got a RIF or something and you designated someone as a beneficiary, that's not really part of the trust? No, it's not. Okay. So I'm gonna run out of time, so I'm gonna skip the things. There's new things, multi-generational home renovation tax credit. So if you're spending up to $15,000, you can get $50,000, you can get back 15% tax credit. So it's like putting a secondary unit in your house. I mentioned some of these other ones, like Ontario Trillium benefit, it still gets missed. All you have to do is enter. Depends on your income level. If you're lower income, you're gonna get a very nice tax credit back, the Ontario Trillium benefit. And it's, you just have to fill in your property taxes or the rent that you pay, and you could get quite a nice credit. So I was just looking at a tax return for a guy that he's about 68 years old, and yeah, he's got about 45,000 of income, but he didn't do his Ontario Trillium benefit, so he missed out on about $1,000. We've gone back and we're gonna change it. And he also had investment management fees that he paid to his advisor. And he didn't, I looked at, he claimed it last year, but he didn't claim it the previous 2 years, so we got another $600 a year back from him for him. So just, those are little things that people miss. Just my last one, and you guys kind of mentioned it, was naming beneficiaries on a RIF. This can be a problem if you, so I had one scenario where a lady had died, and she had a house that was worth $250,000. It was quite a few years ago. And she had one sister that was taking care of her. So she said, okay, my RIF is $200,000. I'll give it to my other sister who lives in England, and I'll leave the house to the other one. So she gets a $250,000 house. Big mistake, because now she has to pay, or the estate has to pay the tax on the RIF that the other one got. So they ended up getting less than, they fixed it up, and they didn't have a bad relationship between them. But you gotta watch that when you name beneficiaries. You might do it like jointly. So it's, and then there's lots of people that don't realize that money then gets paid out, and the fund companies don't have to take off tax. So you could have the black sheep of the family gets the RIF and runs away with it and buys a boat or something, and then, but the estate has to pay the tax on that RIF. So totally unfair, but that's just the way it works. So you gotta be, that's part of your planning, you gotta be careful about that stuff. So he's just asking if you've got money in a RIF or in a TFSA and you've named the beneficiary, can it go over in kind? Yeah. Well, it doesn't, yeah, so can the stocks go over? The stocks are deemed to be sold on your death, and you gotta pay the tax on it. So the beneficiary, yes, can get in effect, they'll get the after, they'll get the investments, but the tax has to be paid by the estate. So you'd have to have money put aside for that tax bill, yes.
Does the TFSA become part of your assets and you need to pay tax on that even though it's tax-free
Yeah.
now?
There's no tax to pay on it. Maybe is your question like on probate or something, but you would, usually you'd probably name a beneficiary and then it's not, doesn't go into, if you don't name the beneficiary, it goes into the estate and it becomes part of the probatable assets. But okay, I went over time.
Okay. Before, we'll certainly have to turn the floor over to questions for any of our panelists, but just to get things going, I've got a couple questions and I'm gonna pose myself. And actually, the first one is to you, Steve. I have a question for you. Are you paying attention or not? Okay.
Going on? Yes.
Perfect. So actually, just this week, I received an email from the Globe and Mail about they sent a summary of payments for the 2023 digital news subscription tax credit. I've never heard of this.
It's been around about 3 years now. It's not a big savings, but if you're getting the Toronto Star, the Globe and Mail, whatever, online,
Oh, why not?
you're not.
No.
You're
Get a hard
getting
copy.
paper hard copy.
Yeah.
You still get it.
Okay.
No, you don't get it. It's got to be digital.
Okay.
Just digital.
Yeah, you did.
Okay, I never heard of this. Okay.
Yeah,
Thank
it's
you.
been around just the last few years, but
Thanks.
it's not a big savings. But
Okay, good to know. And Gosha, I have a question for you. So I have two daughters. One lives here and one lives in the States. And I don't know, and currently they're both beneficiaries on both my husband and my will. So I'm assuming that's a problem. Because one's in the state, so she can't act as they're both the estate trustees. Both estate trustees, both beneficiaries. So one in the States can act as the estate trustee. So what is the best way to set up a will when you don't know what's going to happen? Yeah.
Can you stand up to answer?
Yeah, absolutely. So the question is two parts. One is the executor part of it, where if you're naming somebody that's a non-resident executor, it's not, there's two complications that creates. One is that the person that's a non-resident will have to post a bond or a security to actually take on the role. But the practical side of it from the investments piece is that because they're a non-resident, a lot of financial institutions can't take instructions from them. So even if they were to go through the process of bonding and providing a security for a share of the estate to act as executor, when they end up actually in the role, there's a lot of things that they won't be able to do on the basis of being non-resident in terms of the instructions for investments or the sale of certain assets. So if you have a situation where you have multiple children that you're contemplating naming as executors, the best thing to do is name the ones that you know are resident in Canada. And if down the road that residency changes, that is one of those, what I call big events, where you want to revisit your document and see if there's a different option. It's also one of those situations where if you don't have anybody in Canada and everybody is non-resident, and you just, raise some very global, people that want to live Lord knows where, the option in Canada is to use a professional trust company instead. To provide the services of an executor. So that's on the executor side of things. On the beneficiary side of things, there are implications for taxes that have to be taken into account. Okay, so it's very complicated. It's not a straightforward answer to say this is how the tax planning has to work out. But if you have, for in your example, the 2 children, the one that is resident in Canada is going to receive her half. And, you know, once all the administration is done and the taxes are dealt with. However, depending on the source of the money, whether it's real estate or investments and accounts, the money that is going out of Canada to the non-resident beneficiary may be subject to something we call non-resident withholding taxes. And so it'll reduce the share that that person potentially, right? Like I said, it's not a straightforward answer because there's a formula that's applied and you have to look at certain factors on what the assets are. The other aspect of it is that if your daughter has been resident in the U.S. long enough to have become a U.S. person, she is now subject to U.S. estate taxes on whatever she receives, and that becomes part of her assets, and then it's open to potential estate taxes from that side of things. So it's basically like, please don't leave Canada. I don't know, like everybody that I talk to, please don't leave Canada, don't become a dual citizen. You have dual citizenship, renounce it as soon as you can. It's just, it is very complex, but I think the right tax guidance on the type of assets you own and the way to minimize that non-resident withholding tax is at least a starting point for the conversation.
Gosha, dual citizenship, it's the same thing. It's your executor is dual citizenship.
So the executor piece is more about residency than citizenship. So that's something that you want to bear in mind.
Half and half.
Yeah, so you actually have to show that you're a resident on a regular basis in Ontario. And it doesn't have to do with your citizenship, but your residency.
I have a question for you as well. I have a 26-year-old daughter who made a will a number of years ago. And the lawyer at the time said that when you're moving with your boyfriend or your husband, that the will is redundant. It's not like you have to redo. Is that true?
Okay, so up until January 1st, 2022, the law in Ontario was that if you did a will and then you got married, legally married, it revoked the will. As of January 1st, 2022, that is no longer the law. A legal marriage no longer revokes your will. So if you're somebody that got married before January 1st, 2022 and had a will, that's revoked. If you had a will and you've been married since then, like in the last year and a half, 2 years, I've lost all sense of time. So 2 years, right? Then it's not revoked. Please keep in mind a legal marriage different from common law
So
and
what's
cohab.
the difference? Common law, what is?
Common law doesn't come with automatic property rights in Ontario.
He said it did. He said if you're living with somebody for, I don't know, I've lived for months,
Yeah.
he could get half.
No.
Yes.
That is, please send her to
But that may have changed.
No, it's a valid point. They can be a resident in Canada, but, because they can be resident in Canada from the perspective, as I said, of being able to provide instructions to the financial institutions, they'll be able to work with that. However, it won't waive the requirement for them to post a security act if they're not a resident of Ontario. So they would still have to go through the process of asking, or either providing a bond for some value of the estate, or getting everybody's consent that they don't need to post that security. Depends on the size of the estate. I'm not sure what the formula is, but I do know that it's based on the value of the assets involved.
I have a question for Neela.
I am standing up.
On your presentation, you said the tax-free savings account limit for the maximum is $95,000.
The cumulative amount, so if you've never opened a TFSA and never contributed, that space is available to you. So you can bring forward that room and make the total contribution.
Okay, but the contribution can be over $95,000 over the years.
The total amount would be, if you withdrew let's say you invested in Microsoft or Tesla, and your TFSA grew to $200,000, and you removed last year $200,000. 2024, you can contribute what you removed plus this year's limit.
Okay, but that's, what I'm asking is like the 95,000 is not the maximum you can have in your account.
It's not the maximum you can have in your account, because in the account, there's gonna be growth, there's gonna be dividends. It's just the contribution amounts cannot total more than 95,000.
Okay,
As at the end of this year.
okay. Okay.
Just,
No, I think I'm confused.
okay,
I've contributed my maximum every year,
yes,
okay? So now, if I go over, all those years I've contributed,
yes.
I cannot go over $95,000?
Just in contributions, the value of your TFSA could be anything,
Yeah,
but you cannot go over $95,000 in total contributions by the end of this year. If not, you would be taxed on the over contribution amount.
So if I contribute the maximum, if I've contributed now 95,000, next year I cannot contribute?
So,
Every year.
okay, so let's back up a bit, break it down a little bit. If you contributed the maximum every year since TFSAs became a savings product in Canada, to the end of this year, the total in just original dollars in can be $95,000, but no more.
Right.
Next year, whatever they post for the contribution limit for 2025, you can put that amount in,
Okay,
okay?
right.
Okay,
Or if you've never contributed, you could put in 95,000.
correct, correct, because it's a cumulative amount, so any unused room continues forward indefinitely.
Sir, if I ask you a question, please do speak up.
And
As loud as you can.
Is it for me or for somebody else? Sorry. Okay.
I own a house that's not my primary residence. My daughter lives in that house.
Yeah.
They rent the house. When I pass, she will get that house. So, when that happens, the house is gonna have to have, a tax on it for,
Capital gains tax, yes.
is there any way I can reduce or eliminate that capital gain?
Can you stand up and repeat the question as you
I
answer
can
it?
repeat it.
Thank you.
He was asking about, say he has a house in, his daughter has been living in and paying him rent. If you, when this house gets sold, it's your house, you own it, and you're gonna have to pay tax on that capital gain, all that capital appreciation through that time. So, yes.
Even though it's being left to her will?
Right, usually, so anybody on death, you're deemed to dispose of all of your assets. You know, if it was your house, your principal residence, you're deemed to sell it, but then you show it on the final tax return, but you don't pay any tax on it because there's an exemption against it. But the other stuff, you know, your stocks or your RIF, all of that stuff, you're gonna pay tax on. Yep, yep.
I go back to that, because their trust, it'll go from.
Who's the beneficial owner is a big question. He's saying it's just been in his name. I would probably set it up differently and say that it was, that your daughter was the beneficial owner. You know, instead of paying you rent, she might have given you money as a gift to pay off the debt. I mean, that could be, and then that becomes her principal residence, and then there's no tax on it.
But the house would have to be in her name.
Yes, yes, so you haven't done that
And then
yet.
have something called Pennsylvania thing.
Yeah.
There's reasons why I don't want it in her name.
Then you're stuck with that. So he said,
Yeah.
there's reasons that
It's
you
a
want to keep
no-win.
it in your name and others. At the back?
Yeah.
Sorry, I'll come back.
If your house, your savings, your account, your anything else, if you have it in your children, I've got two, each their name and my name, and when I drop dead or no, I'm going into a cinder box. Do they have to pay tax on anything? Or is it just automatically theirs?
Do they have to pay tax when you die? And the properties were, say, in joint names. The question would really be is, who's the beneficial owner all the time? So if you had investments and you've been reporting the investment income every year, right? Like you're not
Yep.
allocating it to the children at all. In order to put things properly, say to go into the children's name, you would have to sell your investments, pay the tax on it, and now it becomes their investment. The future growth would go to them. But if you didn't set it up that way, it's tax, you're gonna pay tax on it, or your estate would pay tax on the disposition. It's called a deemed disposition, a deemed sale of the property on your death. And your estate would have to pay the tax.
And also, for another question, a friend of mine, her friend, moved in, and as I said, he's only going to stay there for a short time, and he's going to take over, because he apparently is doing this across Canada. And she said, oh no, he wouldn't. How long does he have to stay there before he gets half of it?
No, because you're not, well, a legal question, but if, so someone owns a house and someone is living in the house, you're letting them live there, I don't know if they're paying rent or
No,
anything.
he's not.
He's not paying rent?
No, nothing.
They wouldn't, I guess that's a question, would they ever be considered a common law
Well,
couple?
that's what he is considering as a common law, but apparently he does this for a living. And I just said, you know, I don't know how many months or years, but you wanna be careful, because he's gonna take over half of it.
So if this guy does it for a living, she should look for someone else?
That should be good, thank you. Right there.
Do you have anything to add to it?
Yeah.
Is there a certain length of time limit?
I think the question is, what rights do common law people have after a certain amount of time in regards to funding and
Yeah.
taking over?
Take it over.
None?
No.
So here's the thing with common law spouses in Ontario, they don't have automatic property rights the way that legally married couples do. They have entitlement to certain things once they've established their common law based on criteria, like you have to be living together for at least 3 years, or 1 year if you've had a child together during that time. It reduces, but it has to do with things that they may be entitled to in terms of like employment benefits or pensions. It doesn't relate to property. And so that is one of the big things where a lot of people now are living common law more and more, and they are working under the assumption that they're gonna, you know, if there is no will, that you know, that legislation I mentioned where it leaves everything to your spouse, kids, whatever percentage and breakdown, whatever, you're not a spouse under that legislation if you're common law. So you don't even factor into the way that that's gonna break down. You'll have to make a claim in a completely different way and in a much more complicated way for anything that you've contributed to your shared assets. So there isn't a thing where, you know, you have a company that valued it to your house, like, it's just not gonna happen.
She's had a question for a while.
Any question up front?
I have one child, an adult daughter in Mexico. She's lived there for quite a while. And my brother is named as my executive publisher in the parish. She's also named on those documents. I think you need that problem. I don't know if I'm a lawyer or something, but I speak to my lawyer, my tax accountant, and my investment.
Do you like our lawyer?
Your new lawyer.
Do you like your lawyer? If you like your lawyer, then yes, you should talk to him. Yeah, there are definitely, qualities that they should call me. If you like your lawyer, you should just go work to them and be like, perhaps we need to amend this. I don't know if they were well aware that your daughter is not potentially coming back. I don't know when you had this done.
Yes, no, she lives in Mexico, but
have them done, the documents?
I can visit my will, I'll get my.
Oh, good. All right, so you're my poster child. Like I said,
I don't understand.
I only have to pay $300 every 5 years, and they can take.
You raise another question, though, like, why is your daughter filing a Canadian tax return when she's not living here?
It depends
I think,
if she's on the
I
visa
think
or
you
whatever.
answered it, but I didn't hear the question. My executor, no, for you probably, my executor is my son who lives in BC. Would that be a problem when I drop dead?
No, it's not a bit. It would add a small hiccup in the sense that he's not resident in Ontario, so when we get whoever gets him out here to do the probate application, then there's just an additional step that'll have to be shown that, you know, he doesn't need to post a bond. It's not a particularly onerous
Okay.
step, but it does need to be done, and then obviously, I don't know how many other kids you have, or.
One other, and she's in BC too.
Yeah. Oh, okay, well, then they can just both consent to that, right, so,
Okay, thank you.
yeah.
Question back here.
You didn't get a chance to discuss income splitting or the ability to do that.
He was asking, I didn't discuss income splitting. I
Can
had
you
it in
stand
my
up?
chart, but I ran on too long, so, pension income splitting, I think most people probably know about that, but sometimes they don't. I had a guy that was doing his own tax return for years, and if he did, and he had high income, so then we did the pension splitting, and he saved tens of thousands, I can't remember. So your question is on income splitting, like, can you?
Well, I don't think an IRA qualifies.
Right,
for that.
IRA is from like the US.
Yes.
No, we can't split that one.
Do you have any problems with co-executors, one, two, one?
Good question.
Go ahead, Gosha.
No, okay, so here's the thing you want to keep in mind when you're naming a number of executors. One can carry on and make the decisions, obviously, sole. If you have an even number of executors, there is potential for deadlock because they have to make the decisions together. And so if there's any indication that two, let's say you are trying to pick two people, if you have indications that those two people do not get along, that they, you know, one will say the sky's blue and the other will say there's a purple hue, you don't want to name those two people acting together, right? If you have more than, if you have an uneven number, let's say you have 3, you could include a provision that says majority rules in case of a deadlock. Unfortunately, when it's an even number, there is no way to have that sort of provision. So you just have to be careful about who it is if it's even.
Excuse me, just one addition, can you assign specific responsibilities to those two executors? One sells the house and the other one does all the paperwork?
No, the executors have to wear the full hat because there's a lot of personal liability involved with it. And for instance, if there's the sale of the house, it's tied to how the money is accounted for down the road by the other executor, or there may be tax filing issues that have to be coordinated, so you're not able to carve it out that way. You can name somebody specifically separately for a particular trust you want to set up, because that person's just going to run that one piece of things. But otherwise, for the actual, like the whole estate's administration, you can't carve it out.
Can I ask the other side of that question? As an executive of 2, are there ways to protect yourself on the liability side?
Yeah, there's something called executors insurance in Ontario.
Yeah.
I think it's up to $3 million.
Yeah. Yeah, I would suggest executor insurance. I think the max is $3 million, and I think the thing everybody needs to be aware of, and we see this quite a bit, and this is the caution that we tell anybody who's an executor on an investment account. what tends to happen is mom or dad dies, and then all the beneficiaries start pushing on, when am I gonna get my share, when am I gonna get my share? Remember, when you disperse it without waiting to find out what that tax bill is, and everybody took their piece of the pie and bought the race boat or the race car or the house and the keys, if there's no money in the estate to settle the estate tax obligation, the executor has financial liability, which is where the liability insurance, the executor insurance would come in.
One last part of that. Organizing, if there are two executors, one executor makes a decision without informing the other, and an organization follows through on that, the liability lies with whom? You understand?
So, yes, so I'll talk from the organization point of view. So let's say I die and my executors are my husband and my daughter. If my husband says something and my daughter was not aware of it, didn't agree with it, from a brokerage point of view, we would not accept the instructions because we have a copy of the will that says my husband and my daughter are my executors. That means they both have to sign that letter of direction to the brokerage saying, this is how we'd like you to disperse the assets. Without both signatures, no, it wouldn't be done because we're trying to protect both executors and protect the deceased person's estate as well. Yes, somebody else?
Can you address the positives and negatives of having your power of attorney the same as your executor? Because I'm going through that now, and it's not the same. And the lawyer dropped the ball 20 years ago when my aunt made the will, and I'm caught in the middle. So just for everybody's
Can I give
information.
my personal opinion on that one?
Yeah,
Yeah.
sure.
Not my legal one. So as a power of attorney, when I was power of attorney for both my dad and mom who are now dead,
Right.
the advantage of it being me for both finance and for care was this. One, I'm in the financial field,
Right.
so I had that expertise. Two, they were living with me and I was the one arranging care and I was the overnight care. So as far as decision making goes, for me, it made it a lot easier to be able to say, mom needs extra care, dad needs a hospital bed, okay, here's the check, here's the check, here's the check.
Right.
Without having to go to my brother in BC or my sister in Etobicoke and say, hey, just so you know, the OT came in, dad needs a hospital bed, I'm writing a check for $3,500. I don't have that delay.
Right.
I think from a personal point of view, the disadvantage sometimes of having multiple people being the POAs becomes, let's say the POA for property is in desperate need of those resources after death. And the personal power of attorney for care is all about, I made a promise to provide the best end-of-life care for mom or dad. There's discord, right?
Right.
They're all
Right.
operating at opposite ends. So from that point of view, I think that's when you get the clashing of objectives
Okay.
because of different things. But that is a personal opinion only.
Right.
So
That is the addressing a different POA for financial and physical. My question is more so when you have or have not had the same person who's been there as POA, now you're handing it over to a separate executor, which was a mistake the lawyer acknowledged that he made 20 years ago when my aunt's will was done. So I've looked after her for 15 years. Everything is going to be handed over to an executor who's not, has no involvement. Maybe you could address that. So in other words, advising individuals to make your power of attorney your executor as well. Power of attorneys for both physical,
So I
financial,
don't
and
think that
executive.
you can say one way or the other for every single person.
No,
Because
I guess
a lot of
you,
it depends on family dynamics.
Right.
And where people are resident and what their skill sets are.
right,
And so you can't have the conversation with a client that says, you know, this is definitely the way that you wanna structure things.
right,
i.e. name the same person as your attorney for property as executor. Because there may be a myriad of reasons why you wanna do it a little bit differently.
right,
I often have clients with slightly
Different.
different instructions across the board. Again, it comes back to skill sets, it comes back to location of people, it comes back to how many people there are in the family. It's not as straightforward as saying it has
Right.
to consistently be that way. In terms of your pros and cons, obviously the pro for having the same person at baseline is that they are already aware of all of the assets and the status of things,
Right.
such that doing the administration should not be as complicated for them.
Correct.
However, once you have an estate fall in, there are a lot more immediate administrative tasks that have to be done anyway,
Mhm.
that person may not be prepared for. The flip side of it is the check and balance piece, right? If you've had one sibling that's been managing the affairs for the last 10 or 15 years, and nobody realized that that sibling had a gambling problem.
Right.
And then
Right, that's
your
true.
parent passes away, and they have in fact named all three of their children to act as executors. There's an accountability moment that happens there when they're
Right.
passing things across.
Right.
And it'll come to light in a way that it may never have had the chance to do. Again, you know, part of my, and just wanna highlight this, part of any advice you should be getting on your planning should not just be about the numbers. It's
Correct.
really important to talk about family and dynamics and the way that your relationships work. And I don't think people spend enough time on that. Because you can have the perfect plan and goals in mind, and if people are not coming to the table with clean hands, it's gonna be a mess no matter how you set it up. So, anyway, that's just my 2 minutes.
And just to add on to that, as in Quebec, we don't have, the various provinces do not have an understanding with respect to health and OHIP for Quebec. Quebec has a different type of law. Is that also a concern if an executor lives in Quebec as opposed to, for example, BC?
No, because once they're here, they're gonna be following the rules from here.
Who's once they're here? No, the executor is in Quebec. The person who dies is in.
So they're administering the estate here.
It's coming out of here.
Ontario.
Right.
The assets are here, so
Yeah.
they'll be guided by the Ontario laws in terms
Okay.
of what they need to carry out
Okay.
for the administration.
Okay, okay.
You have 1, 2, or you have representatives when they die before you can change.
Can't hear.
Yeah, so, there's something called a power of appointment, where sort of the last man standing, whoever their executor was, could end up actually being the executor of the estate as well. I actually build in provisions in my documents around the last man, woman, person, standing. Insert politically correct.
So we're at 3:15 and I had said we were gonna wrap up at 3, so I'm respectful of everybody's time, but I know, I can see there's still some hands in the air, so if you feel, I'm gonna say if you wanted to leave, but it's gonna make quite a disruption, so, are we okay to wrap this up now, or is there still a question that needs to be asked?
Wrap it up.
We're good? Okay, so thank you very much to everyone and to.
You have a draw.
Oh, sorry.
You have a draw.
Thank you very much to Gosha, Neela, and Steve for your presentations and providing that valuable information. We do have a draw.